A massive corporation can report billions in revenue and dominate market share right up until the moment of a catastrophic financial collapse. To find the actual breaking point of a business, analysts turn to the corporate balance sheet, the primary document used to track assets and obligations. A balance sheet does not show performance over time. It provides a static snapshot of a company's exact financial position, frozen at a single point in time. This document is an itemized list: the raw cash a business holds, the assets it owns, and the debt obligations it owes. Reading this raw list creates a false sense of security. Raw data alone cannot predict short-term liquidity crises or long-term structural rot that may exist behind a large top-line asset number. The static numbers only gain predictive value when they are mathematically interrogated to show the underlying liquidity mechanics. Analysts use financial ratios to stress test this static snapshot. By systematically cross-referencing specific asset classes against specific liability classes, we map out a company's precise risk profile. In this process, financial health is never absolute. A specific metric that indicates a thriving enterprise in one sector might signal total collapse in another. The context of the industry determines the diagnosis. Applying standard textbook formulas blindly across all business sectors is the primary failure mode of novice investors. To see how a company actually operates, we must construct the 4 primary balance sheet metrics sequentially, observing how they interact. Elite fundamental analysis requires treating these equations as living models of corporate mechanics, rather than rigid mathematical rules. The most foundational question of corporate solvency is simple: can the company actually pay its bills today? To answer this, we extract 2 essential components from the balance sheet: current assets and current liabilities. Current assets represent cash on hand, plus any items expected to be converted into cash within 12 months. Current liabilities are the debts and obligations that must be settled within that exact same 1-year window. Comparing these 2 figures yields our first metric, the current ratio. This diagram shows the calculation, dividing the current assets block by the current liabilities block to determine how well short-term obligations are covered. As a standard industry benchmark, if the resulting ratio lands between 1.2 and 2.0, analysts generally consider the company to have an adequate safety buffer. If that ratio drops below 1.0, the company mathematically lacks the short-term liquidity required to cover its immediate debts, placing it in danger of default. While the current ratio acts as a fast diagnostic tool, it contains a dangerous assumption. It implies that all classified assets are equally and instantly accessible. The flaw in assuming instant convertibility becomes obvious during a real crisis. The primary culprit creating this mathematical illusion is inventory. The official book value of inventory written on a balance sheet rarely matches the actual cash you can get for it in an emergency liquidation. If a seasonal retailer needs cash immediately to avoid defaulting on a loan, they must take massive markdowns to clear unsold goods, realizing a mere fraction of the stated value. To account for this, analysts use a more conservative stress test, the quick ratio. Looking at this updated diagram, we adjust the formula by mathematically stripping away inventory and prepaid expenses entirely from the current assets. This calculation pits only the most liquid assets, like cash and cash equivalents, against the pending short-term debt obligations. Because the numerator is restricted, the benchmark tightens. A quick ratio strictly greater than 1.0 is generally regarded as safe for most standard industries. By stripping away illiquid assets, we remove the optimism, revealing a company's absolute baseline survival buffer against sudden financial shocks. If we shift the mathematical operation from division to subtraction, the underlying business model begins to reveal itself. This gives us the core operational metric, working capital. The formula requires simply subtracting current liabilities from current assets. This split-screen diagram illustrates the traditional baseline on the left. In standard business models, positive working capital, where assets comfortably exceed liabilities, is highly desirable. But here lies a paradox. In specific industries, a negative working capital metric is a sign of supreme operational dominance. We see this exception in massive beverage conglomerates like Ambev and mega retailers like Walmart. These corporations possess immense operational leverage. They have the bargaining power to dictate trade terms to their suppliers. Their mechanics are highly specific. They collect cash from consumer sales rapidly, holding those funds for months before their deadlines to pay suppliers finally arrive. Running this deliberate deficit allows them to efficiently reinvest that floating cash elsewhere, instead of tying it up in idle safety buffers. While a deficit indicates imminent bankruptcy for most businesses, it functions as proof of supply chain dominance for these industry leaders. To evaluate long-term structural integrity, we have to zoom out from month-to-month operational metrics and examine the company's entire capital structure. We do this using the final, most macro metric, the debt-to-equity ratio. This measures a core structural tension in corporate finance, directly comparing what a company owes to creditors against what it owns through its shareholders. This diagram demonstrates the calculation, placing total liabilities on one side of a scale and dividing it by the shareholders' equity on the other. Across almost all industries, a lower ratio is viewed favorably, indicating a business funded primarily by its own generated value. A high debt-to-equity ratio signals financial weakness. It exposes an unsustainable reliance on borrowed capital to keep the entity afloat. Liquidity metrics prove a company has the cash flow to survive the current month. The debt-to-equity ratio proves whether its core foundation can survive a prolonged economic downturn. Competent balance sheet analysis requires synthesizing these four metrics simultaneously. First, current and quick ratios act as immediate survival stress tests. Working capital measures short-term operational efficiency. Finally, debt-to-equity tests long-term structural integrity. None of these numbers mean anything without applying the specific context of the industry generating them. No single ratio provides a complete picture. They must be interpreted together as an interconnected diagnostic matrix. Stop relying entirely on surface-level stock charts and start opening a company's quarterly balance sheets. Test these exact mathematical models against real-world data from the companies you evaluate. Actively look for paradoxes, like Walmart's strategic working capital deficit, to understand exactly how a business commands its market. Always question whether a company is truly solvent or merely masking operational risk behind illiquid assets. Effective fundamental analysis converts these mathematical models into a clear, tangible map of a company's physical operational reality.